बिस्मिल्लाहिर्रहमानिर्रहीम। तो आज हमारा मनी क्रिएशन के बारे में, जिसको हम लोग पहले भी देख चुके हैं। So this is chapter 10 of the text on money and banking. Alright, so what is the money supply? What are financial assets? What do banks do? What is the standard theory of money which is taught? And what is the MMT view? And then we will also look at some balance sheets and yield curves. So we would like to look at what are the definitions of money and the key point here is the standard idea about what money is, which is taught all over, and the reality of money, which we will teach here. And then we will also discuss some things about balance sheets and accounting. Alright, so the high-powered money, HPM, is also called the monetary base. It is cash in circulation and then all of the banks, all of the private banks are required to keep some reserves in the central bank for reasons that we will explain. So if a bank has a portfolio of 1 billion rupees, then it should have about a tenth of that or 5% of that as an account in the central bank. So the banks, just like we keep accounts in checking accounts in banks, the banks keep accounts in the central bank. So these are counted as high-powered money, and this is the definition of M0 or narrow money. So this is defined differently in Australia and UK and US. For the moment, this does not matter to us. Money in circulation is defined as currency plus the bank deposits held by the private non-bank sector. So this is the most liquid. Basically, as we go through definitions M0, M1, M2, M3, M4, these are financial assets with varying degrees of liquidity. So liquidity is the speed with which you can convert something to cash. So for example, a house is an asset, but it's not very liquid. It takes a long time to get cash from it. And note is the most liquid thing. And then you have, in Pakistan, you have prize bonds. So they are highly liquid, but they are not cash. And then you have financial assets, bonds and stocks. These can also be fairly quickly converted into cash, so they are considered as liquid, but with different degrees. So M1 consists of this reserves, which is basically cash plus checking accounts. Now the checking accounts, as we will see, are empty. There is nothing inside a checking account. So the person thinks that he has cash, and actually he has cash in the sense that it is a checking account is a promise by the bank to produce cash. So in effect, it works like cash. So for example, suppose that I were to issue a note to one of you that you can take 1,000 rupees from me whenever you want. So this is a promise to pay. This is called a promissory note. I promise to pay 1,000 to the bearer of this note, and I give this to one student. I don't have money right now, you can cash this with me. And now, suppose that my name is well known in the group and everybody trusts it, then he says instead of cashing it, he just uses it for his own transactions and it starts, so it becomes currency. This is a promissory note. There's no money behind it necessarily, it's just, so this is exactly the nature of the checking accounts. They are a promise by the bank to pay with nothing behind that promise. So but both of them act like money. As long as people trust that this will be paid, then it's just as good as cash. So the second level, so we have M2. This also includes savings accounts. Now, checking account is also called a current account. You can write check on it. Normally, savings account used to have, you get interest on payments on it. Also, you have some restrictions on withdrawals. But these days, there are very little in terms of restrictions on withdrawal. So more or less, a savings account is just like a checking account, except that you get paid interest on your money. Then there are money market accounts. There are banks which, I don't think we have these in Pakistan, but in USA you have an account in which the bank holds your money and invests it in highly liquid money market instruments which pay interest. So you can get a varying amount of return depending on how the stock market is doing. But it's usually, in the money market accounts, your money is kept in very safe assets, which, but it's better than in the standard in savings account, you get 4% or 5%. And the money market account actually invests your money and your return varies depending on how the market is doing. They started these in the market. Yeah? There are also certificates of deposit, money market mutual funds, and other things which are very quickly convertible to cash and not very risky. So these are also counted as M2, which is kind of not very liquid assets, as we might say. M3 is defined as M1, plus there are many kinds of institutions. I don't think we have in Pakistan, but in the USA you have, and the UK there are things called building societies, which in which you can deposit money, and it's just like a bank, but except that it's used for buying houses, etc. And there are other non-bank institutions which can hold money and accounts. So those are also counted as part of your M3, authorized deposit taking institution. In Pakistan we had this scam where people were getting money and offering to pay using supposedly Islamic methods for, so you would put in your 1,000 rupees and every month you would get 100 rupees back as your return. Now this is generally what is called a Ponzi scheme. Do you know Ponzi schemes? You don't know about Ponzi schemes? Everyone who knows about money should know about Ponzi. So a Ponzi scheme is very simple. I promise, I have this great investment in which in companies, and they pay me a lot of money. And if I invest more money, I'll get more money. So I promise that you give me 1,000. The bank is paying maybe 15% for the year. So I promise to pay you 10% every month. So you give me 1,000 rupees, and 1 month later you get 100 rupees. You say, oh wow, this is great. So you tell your friends, and lots more people come. Now what I have done is I have this 1,000 and I gave you back 100 rupees from your 1,000, so I have no problem. I can do this for 10 months. So in the process of 10 months, lots of people learn that we are earning 10% interest, and so huge amounts of money starts rolling in, because this is much more than anything that anybody else can offer. So as people say, yes, this man is fulfilling his promise and he's paying 10%. So as more money comes in, it's easier for me to pay 10% of that money back to the person who has it. And once the momentum builds up and I get a huge amounts of money, and I've only paid 10%, maybe 20%, 30%, I can run away with this money and suddenly, the company collapsed and I'm sorry, nobody will get anything anymore. So this is called a Ponzi scheme because it's very hard to detect. So initially when people are coming in, everybody is getting paid, but when there's enough momentum is built up, then the person runs away with the money. This has been done several times in the name of Islamic banking in Pakistan and in other names in other places. It's not unique to Pakistan. Okay, so broad money as opposed to narrow money is basically tries to take into account everything which is very highly liquid. So it's M3, which takes non-bank institutions and sort of things which are quickly convertible to cash. Alright, so these are a bit technical. So often you will see in your WDI, World Development Indicators, you will see several definitions of money, and depending on how you define money, you can get different numbers. So now there's money and then there's financial assets. So there are two basic types of financial assets. There are stocks and there are bonds. So stocks are technically ownership of a company, a private company usually. So they give you some share of ownership. So if there's a firm and it has issued 1,000 units of stock, then every stock represents 1/1000th ownership stake in the firm. Typically what will happen is that firms use stocks to generate money for themselves. So if the firm wants to invest money in upgrade or expand, then it will put out some stocks, invite people to buy the stocks. Normally it will keep 50 or 60% for itself so that the majority ownership is still in the hands of the firm, and then 40% of the stock is given to the public. So the public doesn't really get a part of the management, in the sense that if you are a majority owner, then you can actually dictate the way the firm is run. You can say, okay, we'll change the chief executive and so on. But if you have minority share, then you cannot do that. So when you sell the stock, you get money, and you can use this money to buy capital or land or factories or machines. So this is one way. The another way to for the firm to raise money is by selling bonds. So a bond is just a bond is something which says that, okay, I will pay you. A bond has a face value. This bond is worth 100 rupees or $100, and a bond usually has what is called a coupon value. A coupon value is just the interest. So for example, I can say that, okay, this is a $100 bond. Let's say it's going to be issued in December 31, 2018. So the maturity date of this bond is December 31st, 2019. So this is a 1-year bond. And let's say that it has a coupon value of 12%. And what that means is that every month I will pay you $1 for holding this bond. So over the period of 12 months you will get $12. So you buy this bond on December 31st, And on January 1st you get $1, and similarly February you get $1, and so on. At the end of the year, you have earned $12 of interest, and then you give the bond back to me, and I give it back. I give you back your original $100. So that's how the bond works. The issue price of the bond is normally equal to the face value, that is the original price. But see, suppose in the middle of the period you are holding the bond, then and 3 months later you have earned about 3 rupees on this bond, and then you decide that I want to sell this bond. Now the bond will mature in December, and at that point it will be worth $100. What's the value in March? That depends on market conditions. So the value of the bond at that time is the price of the bond, and that can be more than 100, or can it be more? Yeah, it can be more than 100, or it can be less than 100, depending on market conditions. The trading price of the bond is not the issue price. At the issue price, it has to be equal to. So when I issue a $100 bond, it will be sold for $100 at the time of issue. So at that time, if the bond is risky, people will not want to pay. And this bond is a promise to pay $100 1 year from now, and I will sell it to you for $100. So now, if there is some risk, then obviously you won't buy it. So in order to compensate for this risk, I have to give you this coupon value or interest. So how much interest do I have to give? Well, for one thing, it has to match the market rate. So suppose you can put your money into a bank and earn 5% on it. Then if the coupon value is less than 5%, then nobody will buy the bond because they can. So it has to be more, and if the risk is higher, then I have to offer more. So, and risk can vary. If the risk is high, then the trading price of the bond will be low. If the risk is low, trading price will be higher. Also, the trading price varies with the interest rate. If the market is offering high interest rates, then you see the bond has a fixed coupon value. It's written on the face of it. So if the market is offering a high interest rate, the value of the bond will be low. And if the market is offering low interest, then the value of the bond will be high. Alright, we're going to do a little bit of mathematics. Do people know the formula for the geometric sum, 1 plus alpha squared? Does everybody know that formula? Oh, good. Okay. So a console is really a theoretical instrument. At some point they used to exist, but it's just useful to do this mathematics in a simple way. So a console is like a bond, but this bond is never retrieved. It just keeps on paying some interest until infinity. So suppose the coupon value is capital R. So that means that if you have a $100 bond, you will be paid 100 times R every month or every year forever. So what's the value of this bond now? So that's called the present value, and it is now there are two values. This is what generally gets confused by students. So there is the coupon value of the bond, which is a capital R, and then there is the market rate of interest. This market rate of interest is the option that you have if you don't buy the bond. So what is the value of receiving capital R amount of money 1 year from now? Well, now this depends on the market rate. So suppose the market interest rate is R, that means that if I take, this is bad because I'm using the same R for both. Alright, but anyway, suppose I have an amount of money M and I put it in the bank. So 1 year from now I will get M times 1 plus R. So that's the value. So now if so M times 1 plus R amount of money 1 year from now is equal to M now. That is the standard present value calculation. So if I'm going to receive capital R, the coupon value 1 year from now, the value of it to me today is R divided by 1 plus R. So the present value calculation, assume that I receive a payment immediately at time 0, which is R. Then I receive a payment of R 1 year from now. So the value of that is R divided by 1 plus R. Now if you go 2 years, then you can apply this step twice, and so the value of the payment R 2 years from now is R divided by 1 plus R squared. And similarly 3 years from now it's R divided by 1 plus R cubed. So basically the present value of this console, which pays R forever every year with an instant payment right now, is this series, infinite series, which I have written, R times 1 plus 1 over R plus 1 plus 1 over R squared, and so on to infinity. Now, the sum of a geometric series, 1 plus alpha squared plus alpha cubed, etc., is 1 over 1 minus alpha. So the sum of this series is going to be 1 over 1 minus 1 over 1 plus R. So it's a bit complicated. So you have 1 minus 1 over 1 plus R in the denominator. This turns out to be, just comes out to be 1 over R somehow or the other. So do the algebra. I forgot to write this up. So the present value is R divided by little r. Now if this actually series terminates, which is the typical case, it's a 10-year bond or a 5-year bond, then the formula is more complicated, but the result is basically the same, that the present value varies positively with the coupon value R and is inversely related to the market interest rate R, which makes perfect sense because the market interest rate is a competitor to the coupon value. The better you can do in the market, the less the value of the bond to you. Alright, now the simplest case is the case where you have treasury bonds. The treasury bonds are called the bonds which are issued by the government. And usually in our calculations we assume that there is no default risk. When a government defaults on its bonds, this is called a sovereign default. These things happen. Russia had a default in 1998 or something, which was a major problem for global financial markets. And similarly, sometimes states are unable to pay because of shortage. Normally what happens is that they renegotiate the loans, but they could also go into sovereign default in the sense that they say, okay, we have no more money, we will not pay. In that case, what happens? Usually states do not like to do that because when they do, then other nations will deny them their imports and so on. So economy will typically go into a deep crisis if this happens. For example, for Greece, they were in big trouble. Now basically if the economy is self-sufficient, then you can go into sovereign default, but typically with very strong global linkages, no economy is self-sufficient. They usually need some very vital imports, and so if you go into default, then you have trouble with your imports, and then you have. So anyway, the point is that the treasury bonds have no default risk, or at least we do the calculations based on this. Now there is the concept of the yield on the bond. This is very important. Yield is not written. The coupon value is written. When the bond is issued, then the yield is equal to the coupon value. Yeah, right. But when it trades later on, the yield will become different. The yield is basically the equivalent interest. See, as you change the price, suppose you have a bond with face value 100, which is due 1 year from now, and suppose that it has 0 coupon value for simplification. You see, the yield is actually the true interest rate that bond is paying. So let me just do that. So now you are getting a bond which is paying $100 1 year from now. This is not the issue, and it has coupon value 0. You can say that all the interest payments that were supposed to be made have already been made on this bond. So now what is the worth of this bond? Well, if the market interest rate is 10%, then the bond is worth $90 right now, because if you put $90 into the bank, you will get 99, roughly 100, 1 year from now. So if you pay $90 or $91 for this bond today, you are getting an interest rate of 10%. So basically the price determines the yield. So if you have a bond which is paying $100 1 year from now, and you pay $90 for it, then you are getting an interest rate of 10%. If you pay $95 for it, you are getting an interest rate of 5%. So that is the yield. The yield is the amount of interest that you are getting on it based on the price you are paying. So approximately, that real formula is more complicated. The yield is the coupon value divided by the price of the bond. This is for risk-free bonds. If you have a risky bond, then the price will be lower and the yield will be higher. There are things which are called junk bonds, which have very high risks. You see, the Moody's, and there are many other agencies which rate bonds, and they are rated as AA or A or AAA or B or C. So the lowest category of bonds is called the junk bond. So these are private companies about which you're not sure whether they will survive or not, and so on. So these are now the bonds have different yields, different times to maturity. For example, the US Treasury issues bonds of 1 month, 3 months, 6 months, 1 year, 2 year, 3 years, 5 years. And 20 years, and so on. So this is just some information about government bonds. So the US bonds 10-year bonds. These are long-run bonds. These are selling in the US at 2.96, almost 3% interest rate. In the UK, the same 10-year bond is paying 1.33, and it has gone up by 0.016. The US long-term bond rate has gone down. Why has the US long-term bond rate gone down? Does anybody know? What would need to happen to the market rate of interest to make the bond rate go down? नहीं, the risk, ये तो सारे zero risk bonds हैं. Yes, exactly. The US Central Bank announced that they will increase the interest rates, and they have been increasing them. As a result, the yield on the long-term bonds has gone down.
If that interest rate goes up, wouldn't this go in the opposite direction? Because when the interest rate goes up, people would go there. So the government would have difficulty to sell these bonds in the long run to the general public. So general public would demand higher interest rate or yield rate in order to purchase these rates. So if the government decreases and cuts down the saving rates currently, so in future they expect that the saving rates would decline, so therefore they jump for treasury bills, and when there is high demand for treasury bills, it automatically would decline the yield rate.
This is too long. So basically this is the yield on the US 10-year bond. This is not the coupon value. So the yield is inversely related to the market interest rate. The market interest rate goes up, yield goes down. Market interest rates have been going up very, very slowly in the US because the central bank has been increasing interest rates, and because market interest rates have been going up, yield on long-term bonds have been going down. It's very simple. Now, the price is inverse. The yield goes down, the price goes up. The price and the yield are inversely related. And that's what tends to cause confusion. In the UK, the yield is 1.33 and it has gone up recently. Japan, the yield is very, very low on long-term bonds, 0.07. This is not 0.7%. This is actually because the market is very sensitive to these rates, what happens is that we measure these in what is called basis points. 100 basis points is 1% interest rate. So this is 2.96 basis points, that's 1.33 basis points, and that's 7% of 1 basis point. It's a very, very small number. In Germany you have 2.9 and so on. These are all yields on 10-year bonds. In Indonesia you have 7.83. This means basically one of the factors that governs the rate is the inflation rate, because your real yield is the nominal yield divided by reduced by the inflation. So the amount of money you earn 1 year from now, the value of it is good. So if there is more inflation, then your yield has to be higher. So in Brazil, we would expect that there is more inflation. Similarly in Indonesia, but Brazil has higher inflation than Indonesia, is what we can tell, because the yield is 10% and in Indonesia it's 8%. South Korea has relatively good control on inflation apparently, because the long-term yield is 2.1, Mexico it's 9, and so on. These represent the expected amount of inflation. So you can see that the Poland, Canada, Australia, Norway have low yields on 10-year bonds. Switzerland has actually got a negative yield, and Mexico and Indonesia and Brazil have high yields. unexpectedly South Korea has a very low yield. So that's the picture in terms of 10-year bonds. Now we can also look at what is called the yield curve. The yield curve is what you get when you look at what is the yield on a bond which is immediately due, which is due in 1 month, which is due in 3 months, and so on. So in the US, the yield curve is starting at 2.96 and it is going down to 2.29, 2.4. One is the 3 month, 6 months is 2.56. 1 year bond is 2.7, 2 year is 2.83, 7 year is 2.89, but then 20 years and 30 years are 3.25 and 3.23. This is the yield curve plotted against the maturity. So a 1 month bond is selling at, as we saw, 0.23. 3 months is slightly higher, 6 months is slightly higher, 1 year is higher, and so on. So the yield keeps going up as the term to maturity keeps rising. This is the picture for Pakistan government bonds. 3 month bonds are available at 10% in the market. 6 month bonds are at 10.55%, and 1 year bonds are at 10.9. 3 years are at almost 12%. 5 year bonds are at 12.1%. 10 years are at 12.5, 14 is 13.5, and 20 years is selling at 13.5 also. Alright, so these are the sovereign bonds, the bonds issued by the countries. There are also private bonds. They can be sold by, actually in the US, the states also sell bonds, and provincial governments like cities and multinationals and private companies and other public and private bodies sell bonds to raise money. When you have firms, they can raise capital by issuing bonds or by selling stocks or by using retained profits. The most preferred method for firms is to use retained profits. So when you have profits, you can either give them out to shareholders or you can invest them. So companies like to finance new capital by using retained profits, but if they don't have enough, they can either sell stocks or they can sell bonds. So these are non-sovereign because they are not issued by the government, and therefore they have a higher default risk. And then there are these rating agencies which tell you whether the quality of the bond. And basically one of the major reasons for the global financial crisis was that the bonds that were being sold, these were called mortgage-based securities. What somebody did was to take a lot of different mortgages of people and put them into a security, and they said that, okay, this basically a bond is a promise to pay a certain amount. So every mortgage is a promise to pay. A person buys a house for $100,000 and then he says every month I will pay $1,000 for the next 30 years or something like that. So the mortgage is basically a stream of earnings of $1,000 for. So you can take a lot of these and say, okay, I have here an instrument, and in this instrument every month you will receive so much money, which is the amount that is coming in from the mortgage. So that's your bond. Now, these bonds have varying degrees of risk. You don't know what the risk is because the person who is, basically every person has his house and he is paying, and he has his own risk profile what is his income like, what is his job security, and so on. So, before this thing started, the mortgage-backed security business, there was very close one-to-one relationship between the bank and the person who was given the mortgage to. They would know who the person is, what his job is like. Normally, mortgages were given to a person who was living in the same place where the bank was, so they would have very good information about the person. And so they would be able to evaluate the risk. Once these started being traded, then the risk characteristic of these securities was not known, because who knows who the person is, how he has been evaluated, so on. So basically, then it was these the security guaranteeing agencies which said that these are AAA, or these are very solid securities, when in fact they were very low quality. So because of the deliberate fraud done by the mortgage rating industry, these mortgages were sold very easily and very widely, and so when they collapsed, this was a big shock. So the point here was that the rating of bonds is a very crucial element of this system, but it doesn't necessarily get done accurately. Alright, now we get to the textbook story of money creation, which is wrong. But basically the textbook story says that a bank receives a deposit of $100, so now it has $100 in its hand. So in order to meet reserve requirements, it keeps $10, but the reserve requirements said that if you have deposits of $100, you must have 10% cash. So it keeps $10, and then it takes the $90 that it has received, which is excess, and it lends it to somebody else, and then they deposit in their bank, and from that 90, the next bank can keep $9 and lend $81, and so on. So this process continues, and with 10%, you get 1 over 1 minus 0.9, so you get about a multiplier of 10. So if there's a $100 deposit, it creates $900 of additional money. This is not how the thing works. Okay, so the reality is that the money is created by the process of lending. So somebody comes into the bank and says, I want a loan for $100,000. So the bank will open an account for this person and will write that this person has $100,000, and it will not check, do I have $100,000 in my possession so that I can put this money. There is no checking. This anybody who comes in for a loan, provided that they meet certain conditions which we will discuss. So the amount of loan that is granted, the amount of money that is created depends on the demand for loans. Money is created at zero cost, so there is no supply curve. Any bank can create any amount of money. Now, once the bank has given a loan for $1 million and it has no cash, then bank says, okay, what I need to do, if demand comes in, I will borrow from the bank. So the bank borrows reserves from the central bank to meet the reserve requirement. So suppose that it has to have $100,000 in reserves. So it generates the loan. Somebody comes in for $1 million. Bank ki chandi ho gayi. Now the bank lends the money at 10%, say, and then to meet the reserve requirements, it borrows $100,000 from the central bank and puts it in its own account. Normally the borrowing is done just by transferring that money. The central bank makes an entry in the reserve account of the bank at the central bank. So nothing really happens. The bank just writes down that this bank has $100,000 credit with us. That gives it the reserves that it needs to make the loan of $1 million. So once the central bank puts $100,000 in its account, that creates high-powered money. So this is the opposite. I mean, what we are taught in textbooks is that high-powered money is created by the central bank and that generates money. But this process is exactly the opposite. The loans that are demanded create money, and the high-powered money is created in response to the demand for reserves. So basically, the standard story says that the bank creates high-powered money, and sets the reserve ratio, and these two things, the reserve ratio and the high-powered money, determine the money supply. But actually, the high-powered money is not in control of the central bank, because the central bank is required to provide reserves to any bank which asks for it, and the banks ask for reserve in accordance with how much they need, according to how much they can lend. So basically, the central bank can set the discount rate. That is the decision, that is the monetary policy decision. Once the discount rate is set, this is the interest rate at which banks can borrow from central bank. And so now, when they create money, they need to be sure that the amount the interest rate at which they lend is higher than the interest rate at which they borrow. As long as that is so, they can fund arbitrary amounts of lending. So you can think of a bank as an empty store which takes money from central bank and gives it to the lender. Okay. Now we talk about some double entry bookkeeping. Like many Muslim inventions, this is, if you look up the Wikipedia entry, it says this was invented by somebody named Pacchioli in Italy, and he has written a book on this double entry bookkeeping. This is a very important innovation, by the way. Now everybody says, yes, Muslims did a lot in accounting, and they had the necessary background to do the double entry bookkeeping, but typically Western scholars have two doubts, that maybe they did a lot of things, but they didn't actually invent double entry, and even if they did invent it, it was not transmitted from Arabs. Italians reinvented it independently on their own. So the real story about double entry is still in doubt, but in many cases there is this whole book called The Theft of History, which shows solidly that there are many things which are claimed to be Western inventions, which were actually invented by others, copied in the West, and then theft actually means deliberately the origins were concealed. Especially for Muslim inventions, this is true because many people were actually tortured in the Inquisition for borrowing from the Muslims. So even if a person was very honest and wanted to show that he had borrowed, he could not do so because the church would torture him. So Copernicus is the most famous example. Everybody thinks today even that Copernicus is the inventor of the heliocentric theory and the inventor of the ellipse, but actually all of the material of Copernicus is available in Arabic books, and he had translations of these books in his library. So it's almost sure that the Copernican revolution, which was a major event in Europe, was not due to Copernicus. Copernicus was just a copyist. So the reason for my mentioning this is not because to complain against Europe's plagiarism, but actually because our students are very much discouraged by the fact that all inventions have been made in the West. Actually, the truth is that you can have our civilization has created great things in the past and is even in the past 3 centuries, which would have been very period of very low productivity. There are lots of brilliant contributions have been made, and even today Muslims are contributing a lot to many different developments. So these are not being highlighted. So just like so there is no reason for you to be discouraged or feel that we are. So when I got to MIT in 1971, I was a little bit afraid that, can I compete with the best scholars of the world? So it turned out that in most places, because you see they are selecting the best students from all over the world, so in a class if there were too many foreign students, the Americans would drop out because grading is done on a curve, and the Americans were just selected from a small pool, so they could not compete with the top scholars from all around the world. So this is the typical case there. So today the material that you are learning, I just checked the Harvard catalog. So Manikiev and other people, they are teaching obsolete macroeconomics. You are getting state-of-the-art macro. Other people are also, these Australians, they are also, and there are some, but very few. And the chances of a revolution occurring in the West are very low, because the orthodoxy has got the profession sealed up. They don't let unorthodox people rise, and they don't let them publish in the good journals. So the chances of, but here we don't have anything invested in the ancient technology of economics, so we can launch a revolution. So I want you to have high goals. Alright, now we go to the balance sheet. This is the double entry bookkeeping methodology. So in a double entry bookkeeping, it's actually quite complicated, and I won't be able to explain all of it, but some simple facts that everything must be shown twice, once as an asset and once as a liability. So asset is something that you own, that you have, gives you value. A liability is something that is harmful to you, and that is a responsibility on you, it's a burden on you. So assets are plus, liabilities are minus. Sometimes it's very difficult to keep track of these things. What is an asset, what's a liability? But in our examples, this will be very simple. So accounting, you go through and you get headaches trying to figure out which side of the ledger you would put this entry on. That's what they go through, years and years of training. But anyway, we are going to look at very simple stuff. So this is a bank A. It has a building which is worth $200. So its asset is 200. Now this building is not a liability. So, but how are we going to get a double entry? So artificially, by convention, because we want to make sure that there is one entry on both sides. So we create this liability which is called net worth. This is not a liability, but it is required for the purpose of double entry booking. And because of this, because we want to make sure, and because there are these conventions, that's why it's not so easy to keep track, because it's not natural, it's not something that you would think. But doing the double entry bookkeeping is very advantageous in keeping track and making sure that there are no mistakes actually. And when you have huge accounts, then mistakes happen. So if you can check two numbers and say that these are allowed, these are both matched, then you are pretty sure that there are no entries. And if there's a mismatch, then accountants spend all nights and days to try to make sure that the two sides of the ledger match. So net worth is an entry which is created artificially to match your assets. And so now you have a liability which is called net worth, which is actually the value of the bank. Its worth is 200. Already we see the problem of accounting, because if I said you, okay, where is net worth going to go, you will not put it in a liability.
So the cash paid for the building is actually the liability.
Yes, but at this time we are not thinking back that long. The bank already owns the bank. So it is its property. So if we go back to the transaction where the bank acquired the building, then it would have paid 200 and it would have.
So but entry is made when they have bought the building.
Not necessarily. You see, I own a building and I decide to open a bank, and I have owned this building for generations. I decide to open the bank inside my building. So now there is no purchase transaction. So this is just the value of the bank, right? All right. Now a customer. So I have my house which is worth $200. I say, okay. I put up a big sign. This is the bank, the Asad Zaman Bank. So it's Bank A. And now people can come in. Okay, somebody walks in the door and says, I want a loan of $200 because I'm going to buy a car. See, this is a good loan because I can easily give it because it has automatic collateral. So if I say, okay, I give you $200, the car is worth $2,000, so you write me a note saying that if I refuse to pay this, then if I cannot make payments, then I will possess your car. So now it's very easy for me to make the loan because there is a collateral. That's also the same thing is true of mortgages. If somebody wants to borrow money to buy a house, it is very easy for the bank to give the loan in the sense that if the person doesn't pay, I can possess the house, and as long as the value of the house. So in the process of the mortgage, one step is to get an appraisal of the value of the house, which is done by an independent third party to make sure that the amount of the loan is less than the, usually substantially less, like about, the bank will give you a maximum 75% or 80% of the value of the house, so that if they need to sell the house to get their money back, they can do so. So anyway, car loans are easy to make because cars are worth something, and so I give you the loan. You have, and how the loan happens? I don't have any cash. I can't give you a loan for. I can't give. But what I can do? Okay, I have an open account for you, and in this account I have put in $200, and here is your checkbook, and you write a check on this, and I will honor. So now after I do that, the balance sheet becomes, I have an asset which is the loan to the consumer. This is an asset because this is due. This is going to come into me eventually when he pays. But I have a liability which is the checking account. The checking account means that if anybody presents a check to me, I have to pay. So this is outgoing. And of course the building and the net worth is same as before. So now the question is, where did the bank get the money that it created? Bank didn't get the money. The check account was created ex nihilo, that means from nothing, by entering the number. In the past, it has happened that banks could actually issue their notes, that this is a, but now typically it's not allowed to issue private money. The bank does not need any prior deposits. The bank is not lending anything. Basically, when I create a checking account, I make a promise. I make a promise that when a check is presented to me, I will find cash to support this check. I don't have to have cash now. When a check is presented, then I will get the cash from wherever. That's not your concern. So a check account is just a legal promise to convert to cash on demand any check that is presented, and to accept payment. If I am asking for something and somebody gives me a check, then I will accept that instead of money. Alright, so now how can this business work? I am giving money as a loan when I don't have any. So there are very important factors which are required. First of all, the customer should be creditworthy. If I give $200 of loan to this person and he runs away with it, you could say that, okay, I created the money out of nothing, so I have lost nothing. But this is not true, because what he has is a check and he can cash that check. He can instantly present to me that check. That, okay, I'll give you a checking account, and let's say, just for mental clarity, that 1 hour later he comes back and he says, okay, here's my check, give me the money. So that's perfectly legal. So now I have to give the cash, but I have to put this step of the checking account to make clear what is happening. Otherwise, it seems like it's the same as my taking cash and giving to him, but this is not the same. So now 1 hour later, when he brings the check, at that point I don't have any money in my bank, but I have a little peon. And I say, okay, run to the bank next door and get me some $200 of cash, and write them a check. So I give them, the bank next door, a check that I will pay you $200 when I get it, and the bank takes my check and gives me $200. Gives my naib qasid $200, and then he runs over with me cash, and I say, sir, here you are, this is your cash. Right? So now the question is, okay, this is done. The man has his $200 and he has gone away. Now I have acquired a loan of $200 on another bank. If this bank doesn't pay, then the other bank is going to ask me for the loan, and now I will not be able to, I will be in trouble. So I can borrow from some third party, but eventually, if I am not paid back the loan, even though I created this money out of nothing, I have to get this money back. Otherwise, I will not be in sound terms. So basically, if the people who take loan from me, like the mortgagers, they promise to pay $1,000 every month for the next 30 years. So I've given them a huge amount of money. I haven't actually had any money. This can happen. I gave $100,000 to somebody, which I didn't have, and now this man is going to pay me $1,000 every month. And he took this $100,000 and he gave it to the previous owner. The previous owner receives a check on my bank for $1,000. He deposited in some other bank. So now this bank wants my $100,000 from me, which I don't have. Now, what can happen is that other bank also gave a mortgage loan of $100,000, and that man paid to some other person, and that other person opened an account for $100,000 in my bank. So this can happen. So then these two loans cancel each other, and this thing can happen all over the economy. And ultimately they don't cancel, but there's some plus, some minus. Some bank has a plus entry, some bank has a minus entry. So then you have what is called interbank borrowing. So the person who has a plus entry, they have some reserves, which is actually, there is no money in the system anywhere, but somebody has suppose that my 100,000 which was deposited at bank B and nothing came to me. So now the bank has a credit on my bank. So they have, technically, without necessarily cashing it, they have reserves. Now suppose that they use these reserves to pay bank C and D and F. So now my credits are going to other banks, and ultimately at the end of the day, I will end up owing some different types of banks, different amounts of money, but somebody will have credits. Any bank C, D, and E, suppose they all have $30,000, they have money. Now I can borrow this money from them. This is my own money, invented money, which now when deposited at bank C, it is like cash for them, because it is a cash that they can get from me. Now I can borrow this back from them. It's a very tricky system. That's why nobody understands it. So this cash which I invented out of nothing, when it went into the hands of the customer, it became real, and then it was deposited in the other bank, it became real. Now I need this $100,000 to pay some bank XYZ because the money kept circulating. Now there is money, 100,000, which is sitting in bank B, which came from this invented money. I can say, you have this extra money, please lend it to me at the interbank borrowing rate. So I borrow it and then I pay off my own liabilities to other banks. Alright? Now all of this system works as long as real money comes in at some point. When the person who borrowed 100,000, as long as he keeps paying these $1,000, then eventually the invented money will be replaced by real money because they are paying me cash. But if that customer stops paying, then we are in trouble. This is a whole house of cards and it can collapse because there's no real money, it's all fake money that's circulating. So there are two things. One is the creditworthiness, the other is how much reserves can I borrow. So there are also limits on that. There are rules and regulations about how much I can borrow from other banks. The bank, in order to be sound, has to have a certain amount of assets. The so-called Basel I and Basel II and Basel III, these are regulations on banks which govern how much real cash they need in order to support different types of financial transactions. So I have to follow these rules. I can't just borrow arbitrarily everything. So this example that I'm doing will not work in reality because I will need more assets in order to be able to make loans, because that would go against the rules. And so if I have $100 of liability and I say, okay, to the central bank, lend me $100, so they will look at my books and they will say that no, you're not authorized, you're not eligible for a loan of $100. So according to these rules, I can lend, and then so there are these two things. I want to make sure that if I make a loan, it will come back to me. If it doesn't come back, then it will eat into my real capital. And this is confusing because I created the loan out of nothing, so it seems like even if nobody pays me back, I lose nothing. But this is not true. And the second thing is that, even though I created out of nothing, it creates real liabilities on me. I have to produce cash on demand, and so I will need to borrow reserves. So I have to make sure that I am able to borrow enough reserves to be able to meet the liabilities that are generated by the loan that I made out of nothing. So these are the two major things that I need to make sure that this system works. If these are not satisfied, if I can't borrow the reserves that I need, or if my customers fail to pay me the money that they borrowed, then the bank can go into trouble and it can become illiquid. Net worth can become zero. It can go into bankruptcy, and this happens all the time because the system is really. All right, so we illustrate this in the balance sheets. So here the balance sheets are written with change in assets and change in liabilities. This means that all the background is suppressed. So that makes it easier to record what is happening as a result of this transaction. So that what's happening, so at first step, the customer took a loan from A. At the second step, he used that loan to buy the car. He paid the dealer the $200 that he had borrowed for me, which was only in my checking account at the moment. And then he wrote a check on the account to dealer, and the dealer deposited the check in bank B. So now what happens to the balance sheets? So change in assets. The customer owes me $200. That's bank A. I've written this in red. It's not in the original sheet because there is no change here. But I just wanted to put out that this 200 loan is going to come in to me eventually. If the customer who borrowed money from me to buy the car, he has to pay me 200. So this is here. Now change in liabilities. I had a checking account which was a liability, and that liability which was a plus 200, which means I had to pay 200. Now that went down by 200. I have no more liability to the customer. My liability to customer is zero, but the liability to bank B became 200. So now instead of owing 200 to the customer, I owe 200 to the bank B. What about the bank B balance sheet? The balance sheet of bank B, it got an asset which is $200. This is my check which is lying in the bank. So now it has a claim on my reserves, because what will happen is that this check that Bank B has will not be sent to me. It will be sent to central bank for clearing. And so at the central bank, the bank will look at my reserves, look at the reserves of Bank B, look at the reserve of Bank A, and make the transfer between them. Actually, it has millions of transfers, so it makes all of those things and calculates the net result. But basically, from this particular transaction, Bank B got a claim on 200 and liabilities. The car dealer now has in his checking account 200 more than he used to, so he can now write a check on this bank, so which this bank will now have to pay. So it got an increase of $200 because the check was deposited, but the check was deposited in the checking account of dealer, and so the dealer's checking account value went up by $200, and so now the dealer can write a check on his own account. So that's a liability of this bank, right? Clear? इसको तो क्लियर ये बैंक करे, बाकी सबको भी क्लियर है नहीं? It's very simple, right? Okay. All right. So now, what happens? Well, now at the end of the day, clearing happens. Now this bank A has zero reserve. Let's suppose this is not really allowed, but we say okay, or it has. Okay, so let's assume zero reserve. So now this bank B, at the end of the day, central bank says that Bank A owes Bank B 200, so let me get some reserves, but there are no reserves. So what's going to happen? Well, Bank A says to the central bank that please lend me $200 so that I can pay Bank B. So now the central bank is required to do this. If the bank is solvent, is in good standing, then the bank must make the loan to the bank. This is by law, because if it doesn't, then the system would collapse. The system works because the central bank is there. So in some sense, all banks are public banks. This is very important to understand, that if the government wasn't there, if the central bank wasn't there, private banks could not function. So there is a very strong movement to deny this and to say that banking should be private and everything should be privatized. But this private bank exists because the government strongly supports it. If the government withdrew its support, private banking could not exist. So what happens to Bank A? Bank A borrows $200 from the central bank. So it now has an asset of $200, which is the loan that he has taken. It has a liability, which is a debt to the central bank of $200. So that's your double entry for the Bank A. Central bank, it has made a loan to Bank A, so it has now an asset, which is the loan to Bank A, which it will get back, and it has a liability. Its reserves have increased. The liability in terms of reserves have increased by 200. Now, after this transaction, Bank A has acquired the $200 which it needs to pay Bank B. So now it makes the payment, and what happens is that its assets goes down by 200, which was the reserve, the loan it took, and its liabilities also goes down to Bank B goes down by 200. Liabilities to central bank doesn't change. It now has a liability to central bank instead of to Bank B. What about Bank B? It acquired reserves of plus 200, and the claims on Bank A were wiped out. So, simple transaction. So, debt between two banks has been settled. The final balance sheets are that Bank A, it made a loan. It gave cash 200 to customer, which it got by borrowing from the central bank $200. So now the balance sheet is clear. It borrowed $200 from the central bank effectively and gave that cash to the customer. And it had this building of 200, its net worth is 200, so sheet is balanced. What about Bank B? Bank B now has reserves of 200. This is actually like cash, because this reserve came from the central bank. When you have a liability on the central bank, that is cash. Because so now Bank B owns cash worth 200. This is why we are going through this, because the original transaction, when the Bank A made a loan to the customer, there was no money in the system. But through all of this mechanism, suddenly $200 of cash has been generated, right? Now $200 cash came into existence when the Bank A borrowed money from the central bank, because the central bank's borrowings are cash. So now Bank B has cash of $200, and this cash is actually increases the liability of, it has a checking account which also has additional $200. You see, and the confusion arises by thinking that the bank takes this reserve and puts it into the checking account of the dealer. No, you have to keep these two things separate. It has reserves, which is $200, and it has this checking account, which is a legal liability that if somebody sends me a check, then I have to produce money to match it. So these are the two separate things, but it's balanced. Now in the central bank, the bank made a loan of 200, and it's had a loss of reserves of 200. So that's it. Alright, so the last topic on the agenda is the yield curve, which is in the appendix. So we already saw some yield curves for Pakistan, started at 10 and was going up to 12. So basically the yield curve tells you if you buy a short bond, the short run bond is very closely tied to the discount rate that is being offered by the bank, because that is the rate at which central bank will lend. So a short run bond will be offering rates which are close to that rate. The long run bond will also have some idea about what you expect for inflation, and will also have some compensation for risk. So here are the yield curves in Pakistan for 0 months ago, which means current. The current is the blue line at the top. It's starting at the 10%. I think this is before the recent policy. So this is when the central bank rate was 8.5%. So on 1 year on very short term 1 month bonds, the rate is 10%. And it rises to about 14% as you go from 1 month to 2 years, 4 years, 6 years, 8 years, 10 years, 12 years, 14, 16, 18 and 20 years. Now if you look at the green line, that is what the case was 1 month ago. 1 month ago only, acha. So 1 month ago the rate, so I guess this is current then. 1 month ago rate was 8.5, and so the rates were, so this was also the rate of the, so basically the discount rate and the 1 month rate were the same. And then as you go longer, the market expects the yield to increase because they're expecting that there will be more inflation and also the yields will rise. So, but not by much. The market is expecting that the long run interest rate 20 years will only be 14%. It's not, market is not expecting hyperinflation or anything like that. If you look at the 6 months ago, the rate was around 6.25%, and it was going up. Now, actually, the rate was, I think, the discount rate was 6.5%, but the bond was only 6.25%. Can anybody? This is a 1 month bond. The discount rate was 6.5% for overnight. So can anyone explain why the 1 month bond would sell at a lower rate than the lower yield than the 1 month overnight discount? No. Yeah, suppose that this is 6 months ago. The central bank discount rate was 6.5%. The central bank wants to sell, the government sells a bond that I will pay you some money 1 month from now. So this is a 1 month bond. So I give you $100 and or 100 rupees or 1,000 rupees, and 1 month later, when you redeem it, you will get 1,000 plus 6%, not 6%, but 6% monthly, 5 yani divided by 12. The 6% annual rate of interest. So, if the overnight rate remains the same for all 30 days, then you can borrow from the bank at 6.5%. Now, and that would be what you would end up paying for 1 month of borrowing, if you just do it repeatedly every night for 1 month. But the government offers you a bond that, okay, 1 month you have, so you will get 6% or 6.5% or 6.25% 1 month from now. So these are the two options that you have to compare. So why would it be the case that the monthly bond, the 1 month from now, would be worth less than the overnight rate? So you're considering these two alternative strategies. That one way is to just keep borrowing every day, and one is to lock it in for 1 month.
Maybe due to the election, the government was.
No, it was not election. Well, I mean, that's remote. It could be due to election, but it has to do more directly with interest rates. Basically, if you think that the interest rate will remain at 6.5% for the whole month, then you don't want to buy this 1 month bond. So what would you be thinking when you would like to buy this bond?
We are thinking the interest rate is going down.
Yes. If you think that the interest rate might go down, not that it will go down, but that it might go down, and you want to make sure, if you think there is some probability that it will go down, then you just want to lock it in for 1 month instead of taking the risk. So at that time, at least if it's 6.25, it's just the possibility that also over 1 month there's no inflation, so there's no issue of that. So basically the issue is one of the possibility of it going down. So at that point the central bank had cut the rate and maintained it at a low level and was cutting. And in fact, if you look at the voting pattern, there was, I'm not sure what it was last month, but I think that there were no votes for down. So in that case it's a bit surprising. But if there is some uncertainty about the possibility that it might go down, then the rate could be lower for locking it in. But if everybody thinks that it's going up, then the rate would be higher.
So why now they have increased the interest rate drastically?
Yeah.
Why have they increased? Just because of expected inflation to be occurred?
It's complicated. There are two factors that require addressing. Basically, the interest rate is a way to control the aggregate demand to make sure that it doesn't exceed the amount required for inflation, and also it's a way to control the exchange rate, because if you offer more money on the rupee, then your pressure on the exchange rate goes down because rupee becomes more attractive.
Wouldn't it hurt negatively the economic growth because the
Yes,
investment would be very
it has an adverse effect on growth.
because
Yes,
the businesses won't be able to borrow the money from banks at
that's
a
true.
cheaper rate as
However, the state bank has long-run facilities for long-run investment, on which the interest rate has not changed. So if you want to make long-run investments and borrow on these, the interest rate is the same as it was. This is for overnight rate that it has gone up. All right, so that's all for today.